I greet you, ladies and gentlemen, as I come before you to make a presentation in line with our course outline. I'm making a presentation of a lecture in this lecture series on central banking and monetary economics. As I said in a previous lecture, the first lecture, which is an inaugural lecture, we are going to be exploring 7 major topics. I made some slight modifications to the topics that I enumerated yesterday, as shown in the course outline that I circulated this evening, the 28th of February 2022. So I just want to rehash the topics that we are going to be covering in line with the modifications that I made today as I was revising the course outline material to align it with trends in the modern economy. The first topic is entitled "The Central Bank Goals, Targets, and Instruments." So it's no longer what I presented to you yesterday or what I mentioned yesterday, but the course content is more or less the same, but the topic is now the central bank goals, targets, and instruments. And then the second topic is the central bank independence, time, consistency, and credibility. And then the third topic, central banking and the globalization of financial markets. And then topic number 4 is monetary policy in theory and practice. The fifth topic is interest rate theory. The sixth topic is money in macroeconomics, frameworks of analysis. And then the last topic is foreign exchange markets and economic management. So this is what we're going to be covering. Yesterday, I outlined quite a number of issues that are tackled by central banks, and I also came up with an operational definition of a central bank, this institution which is called a central bank. So I want to proceed from there as I cover issues to do with the mandate of a central bank. And what we want to zero in on before we look at central bank independence is to look at tools of monetary policy, tools of monetary policy, because the central bank is the institution in an economy which operationalizes monetary policy. So we want to look at tools of monetary policy in detail. And at a certain stage, I'm going to circulate notes via email and WhatsApp to assist you to have a comprehensive coverage of the tools of monetary policy. But before I look at the tools of monetary policy, I just want to cover some goals, some basic goals of monetary policy. When we are looking at monetary policy, we're talking of a set of policies which are operationalized by the central bank, in which the central bank either institutes certain measures to affect credit conditions in an economy, or to affect money supply in an economy. The quantity of money which is circulating in the domestic economy. And by the quantity of money which is circulating in the domestic economy, we are referring to both local currency and foreign currencies. Because the two, there's generally a symbiotic relationship between foreign currency and the domestic currency. Which is why when you are looking at foreign currencies, they are called high-powered money vis-a-vis the domestic currency. So monetary policy, once more, to just give a working definition, before we give a thorough definition as we progress with the syllabus content, it is a set of policies in which the central bank or monetary authorities, they either institute measures to affect money supply in an economy or various money aggregates in an economy so as to affect the availability of money in an economy, or measures that are implemented by monetary authorities, either directly or through the banking system, through commercial banks or merchant banks, in order to affect credit conditions in an economy. So that's the tentative definition that I can offer for monetary policy. What are the goals of monetary policy? One of the major goals of monetary policy is to target a low level of inflation, which is considered healthy for the economy. If inflation is too high, we know that under normal circumstances, a contractionary monetary policy has to be instituted or implemented in order to address that problem. And monetary policy is also implemented in order to deal with the problem of unemployment in an economy. If there is massive unemployment in an economy, you may discover that the central bank may institute expansionary monetary policy measures or instruments. And then the other reason why monetary policy is frequently implemented in an economy is to complement fiscal policy. In an economy, you've got the fiscus, which is the budget of government, and then you've got the money markets. So the budget of government, or the fiscus, cannot work alone. It needs the other pair of the scissors, which is your monetary policy, which generally governs the money in circulation in the economy and also credit conditions in the economy. So you need monetary policy in order to fine-tune certain fiscal policy measures that the government would have instituted through its line ministries or through Treasury, because there are two major implementers of government policy, macroeconomic policy. You have got, on the one hand, the fiscal authorities, who are represented by the Minister of Finance or the Secretary for Finance or the Chancellor of the Exchequer in the case of the United Kingdom, but generally the Minister of Finance in many countries. That constitutes the fiscal authorities or the site of the fiscus. And then the site of the monetary sector in an economy is represented by your central bank, which institutes monetary policy measures in an economy to deal with certain specific problems. So you need a synchronization of your fiscal policy and your monetary policy. The fourth reason why monetary policy may be implemented, it may be implemented in order to affect exchange rates in an economy. Like when an exchange rate is depreciating very rapidly, you may discover that the central bank may raise the benchmark interest rate, like what happened today in Russia. We know that currently Russia and Ukraine are in a conflict situation. The Russian Federation invaded Ukraine, and because of that, Western countries, mainly members of the European Union and the United States, instituted far-reaching economic sanctions, which have triggered a mini bank run, if I may put it that way, in Russia, for most of the commercial banks in Russia, and also triggered the depreciation of the Russian ruble, which is their domestic currency there in Russia. And for this reason, the interest rates were increased from around 9% to around 20% in order to attract domestic savings and thus show up the value of the Russian ruble. According to the figures that I saw when I was reading a certain article this afternoon, the 28th of February 2022, it was said that when the Russian ruble was depreciating before the intervention of the Russian central bank, at one point it depreciated to 119 rubles to the United States dollar before settling or stabilizing to around 109 point something to the United States dollar. So you can see that the interest rates were increased by the Russian central bank in order to show up the value of the Russian ruble, or in order to support the Russian ruble. And then the fifth reason, which is related to the institution of monetary policy in order to affect exchange rates, is the implementation of monetary policy to affect, international trade, the balance of trade. If there is easy money, which is causing people to borrow a lot and then buy a lot of things from abroad, the central bank may institute tight monetary policy, thereby making credit in the domestic economy expensive. And by so doing, the central bank will be in a position to dampen excessive demand for imports, leading to a decline in imports at a time when your exports are either constant or increasing, thus narrowing the gap between exports and imports. If there was a balance of trade deficit, the balance of trade deficit may be overturned to a balance of trade surplus, or it may be improved to a smaller balance of trade deficit, or even a balance of trade balance, which is just the a situation of equality or equivalence between your imports and your exports in an economy. So what are the tools of monetary policy? Before I go to the tools of monetary policy, there is a sixth reason why monetary policy may be implemented in the domestic economy. It may be implemented to make conditions in the domestic economy attractive to foreign direct investment. Like when domestic interest rates are increased, assuming that other countries keep their interest rates at a certain level, the interest rate differentials may be such that there will be, for inflows of foreign currency due to foreign direct investment, as foreigners or foreign investors would be investing in domestic money markets, investing in those financial instruments which are denominated in terms of local interest rates. And thus, this will lead to an inflow of foreign direct investment. But that kind of a situation is a double-edged sword in the sense that inflows of foreign currency today, they translate to outflows of foreign currency as investment income to abroad in the medium to long term. So what are the tools of monetary policy? As we cover the preliminary issues in our course outline, some of the tools of monetary policy are interest rate adjustment. A central bank may influence interest rates by changing the discount rate. The discount rate is also called the base rate or the rediscount rate. This is an interest rate which is charged by the central bank to banks for short-term loans. From time to time, commercial banks, which constitute the money markets of an economy, may discover that their liquidity is quite tight, and even if they were to liquidate the near term, liquidate the highly liquid financial instruments, they still remain with severe shortages of liquidity in order to settle liabilities which will be falling due. In that case, commercial banks or banks would borrow on a short-term basis from the central bank, and they are charged an interest rate, which is called the base rate, the discount rate, or the rediscount rate. If a central bank in an economy increases the discount rate, the cost of borrowing for the banks increases. This translates to a scenario in which banks will find it unavoidable to increase the interest rate that they charge their customers. Thus, if the bank rate is increased, the cost of borrowing in the economy in general increases, which leads to a tightening of liquidity or a decrease in money supply in an economy. The second instrument of monetary policy is change in reserve requirements. We're going to look at the credit creation mechanism at a certain point, either together by me giving a presentation of the credit creation mechanism, or by way of a take-home kind of an assignment where you investigate the simple and the multi-bank credit creation mechanism. But you need to know that how commercial banks may also contribute to liquidity in an economy. So central banks usually set up the minimum amount of reserves that must be held by commercial banks. If this required amount is changed by the central bank, this affects money supply in an economy. And the way and manner in which the central bank affects these required reserves is by raising what is known as the reserves requirement ratio, the triple R. In Zimbabwe, it's called the reserves requirement ratio. You increase the reserves requirement ratio, you reduce money supply. You reduce the reserves requirement ratio, you increase money supply, money in circulation in an economy. And then we've got open market operations, which are instrument, instrument number 3. With open market operations, this involves the purchase and sale of securities issued by the government to affect money supply. These securities are government bonds or treasury bills. In Zimbabwe, we call them treasury bills. If the central bank wants to increase money supply, it simply buys treasury bills. It redeems treasury bills or buys treasury bills, which are held by people in the private sector or by private sector players, which may be either banks or certain corporate entities, which would have purchased, treasury bills. So when treasury bills are purchased by government, money is credited to the accounts of those institutions or entities that will be holding treasury bills. And the net effect is that money supply actually increases in the economy. But if the government wants to reduce money supply in an economy, it can either sell treasury bills, thus mopping excess liquidity in an economy, or the government may actually lengthen the tenure or the lifespan of certain financial instruments or treasury bills. You may have a 3-month treasury bill tenure being lengthened to 6 months or 9 months or to a year, or even you may have a situation where a short-term treasury bill of less than a year in terms of its tenure, being transformed into a perpetuity with the offering of an attractive interest rate to the holders of those financial instruments. And then when we are looking at monetary policy, there are other instruments like moral suasion. These are non-quantitative instruments like moral suasion. Moral suasion, it's a scenario in which the central bank, makes certain recommendations which are not legally binding, but are generally taken into account and taken seriously by money market players because of, the elevated nature of the central bank and the fact that the central bank sees money market and economic conditions from a global perspective. So moral suasion, it has to do with the central bank making certain recommendations that are implemented by commercial banks, but which recommendations are not necessarily directives or directives as in as in statutory instruments which are legally binding to all money market or commercial banking institutions or money market players. And then we've got selective credit controls. Selective credit controls in countries with developing, economic sectors like the agricultural sector. It is quite customary for the central bank to receive certain funding from central government and then make available that kind of funding to commercial banking institutions and stipulate that that funding should be related to favored sectors like mining, agriculture, and tourism in the case of Zimbabwe. We know those sectors that I just mentioned are major foreign currency earning sectors of the economy. So that's that on selective credit controls. So there are quite a number of instruments of monetary policy, but I thought of covering those instruments of monetary policy. And my coverage, as you can see, ladies and gentlemen, or as you can realize as students of economics, you can realize that my coverage is not really exhaustive, but it's to tease you to investigate more on instruments of monetary policy. At a certain point, as I said at the beginning, I'm going to circulate some course material so that it can assist you in gaining a deeper understanding of the tools of monetary policy. The tools of monetary policy. And the different tools of monetary policy affect different money aggregates. They affect different money aggregates. Some tools of monetary policy are designed to affect the narrow definition of money, which is your M1 and your M2, whilst other tools of monetary policy are designed to affect, the broad definition of money. But one thing which we need to realize with monetary policy is that it's a very important component of macroeconomic policy, as it were, and it's very imperative that we have an understanding, a deep understanding of monetary policy, and why monetary policy is actually implemented in most economies. There are all sorts of issues like, inflation targeting in an economy, because inflation is a serious issue in most economies. As we are talking right now, there is quite a bit of debate, in economic circles among economists about the actual causes of, inflation in the Zimbabwean economy. But one of the causes of inflation in the Zimbabwean economy is speculative behavior in the foreign currency markets. We've got an official exchange rate which is actually misaligned from the parallel market exchange rate. The official exchange rate is around 121 Zim dollars or RTGS dollars to the United States dollar, whilst the unofficial exchange rate varies between 200 and 240 RTGS dollars to the United States dollar. So you realize that the exchange rate in the parallel market or in the black market, it has depreciated quite seriously, whilst in the formal economy, the one which is regulated by the central bank, it has remained static or stagnant. It has remained static or stagnant. So one of the major reasons why monetary policy is implemented, it is implemented to deal with the challenge of inflation, because when there is inflation in an economy, it affects all other macroeconomic aggregates. All other macroeconomic aggregates are destabilized in the economy. It's next to impossible for an economy to actually achieve stable and sustainable levels of economic growth when there is economic instability occasioned by, inflation. We know when there is inflation, it becomes very difficult for businesses to plan. And as a result, economic activity tends to fall back, and even the level of investment in an economy, it tends to decline due to inflation. Inflation acts as a tax on those who serve, and it generally discourages saving and promotes debt-end consumption. When people receive incomes in a situation of high inflation or galloping inflation or hyperinflation, people are more prone to, or they feel compelled to spend whatever they get as income. So it's very important that the central bank regulates inflation. Inflation as a phenomenon is not entirely bad, because for producers to be incentivized to continue producing, it's very imperative, ladies and gentlemen, that there be modest increases in prices. We know from the elementary law of supply that there is a positive relationship between quantity supplied and the price of a commodity. So if the price of a commodity increases, quantity supplied also increases, ceteris paribus. So if the price is constant, it means quantity also would be constant, hypothetically speaking. It means quantity will also be constant. So we know that in the ordinary run of things, the monetary authorities, they wouldn't love a situation where quantity supplied of most commodities in an economy, where a scenario in which quantity supplied is more or less constant, because it would imply that the economy is not growing. And if the economy is not growing, yet population in most cases grows over time, it may spell a trouble for monetary authorities or trouble for people who run the economy. People who will be running the economy. So it's imperative that monetary policy tackles the aspect of inflation. But it's not only inflation which is targeted by monetary policy. Monetary policy also seeks, especially in the short run, to also target real variables such as real GDP, real interest rate, real wages, the real exchange rate, and unemployment, which is a real thing, which can be measured. We know each of these variables has got a nominal version of it. There is nominal GDP, nominal interest rates, nominal wages, and the nominal exchange rate. But we don't have nominal unemployment, because unemployment is always in terms of a percentage of people who are not working in relation to the total labor force in an economy. So I've covered quite a number of things or issues that are related to monetary policy. So I just want to summarize and most probably add one or two details to what I've covered this evening pertaining to monetary policy. Monetary policy is that sub-discipline in monetary economics in which we study how central banks conduct monetary, how central banks regulate monetary conditions or conditions of money supply and credit conditions in an economy using certain instruments. And there is a transmission mechanism that is involved in between the institution of a monetary policy instrument or the triggering of a monetary policy instrument and the intended result, which is, say, stable and low levels of inflation in an economy, or high levels of economic growth or high levels of employment, which implies low levels of unemployment. Now we know that the transmission mechanism of monetary policy, it includes households, firms, and the financial sector just in general. Because households and firms, they experience intermediation of whatever they have or whatever they need through the financial system, which is normally called financial intermediaries. The financial system is also called financial intermediaries. So, and also I made a brief enumeration of financial instruments such as your open market operations, your interest rates, moral suasion, and so on. So in the detailed notes that I'm going to send to you, you realize that there will be diagrams that will be demonstrating the effects of various policies when they are instituted. You know, in a situation where we are looking at, say, the aggregate demand, aggregate supply, modern. If you institute monetary policy, say you institute expansionary monetary policy, we know that it may have a direct impact on aggregate demand in an economy. Your aggregate demand may actually shift upwards. It may shift upwards to show an increase. Your aggregate demand may shift upwards to show an increase. And this upward shift may translate to an increase in the general price level, which is also accompanied by an increase in the equilibrium level of national income, all other things being constant. So all these things, they can be demonstrated using diagrams, ladies and gentlemen. We can easily demonstrate this using diagrams, where in the aggregate demand, aggregate supply framework, we are able to see how the macroeconomy is affected by the implementation of a monetary policy measure. So I just want to demonstrate how, for instance, if the central bank decreases interest rates, how it can affect the macroeconomy in terms of what I've just been saying, that in the aggregate demand, aggregate supply model, we can see a situation where an increase in money supply, most probably occasioned by a decline in interest rates, will lead to an increase in the general price level, which is accompanied by an increase in national income. So I'll demonstrate this using a diagram. I'll use a diagram to demonstrate this. I'll use a diagram. Let us assume you have a framework. Let us assume you have a framework. A framework. Let me undo that. Let us assume you have a framework. A framework where the horizontal axis shows your national income, NY, and then the vertical axis shows your GPM, and then that's the origin. So the GPL is your general price level. So we know that aggregate demand from undergraduate, it is downward sloping because of the many reasons that were proffered when you are doing your undergraduate economics. And then your aggregate supply, and this is the short run. It is the short run aggregate supply. Your short run aggregate supply, it is shown as SRAS. And the equilibrium, our equilibrium is at that point where we've got E, so we have E0. Now, in our experiment, we say let interest rates increase. If interest rates are reduced, I mean to say, which is what I just said a short while ago, if interest rates are reduced, let me undo that. If interest rates are reduced, we know that this may stimulate aggregate demand. Aggregate demand might be stimulated from 80 to 81. Thus, your aggregate demand curve will shift from 80 to 81. And your equilibrium level of national income, let me use another color. Your equilibrium level of national income may, we expect it to increase from Y0 to Y1 to Y1. Ceteris paribus. And the new equilibrium point will be E1. It will be E1. So the economy has moved from E1, which is associated with a general price level of P0 to E1, which is associated with a general price level of P1. And the general price level has increased, as I said. So in this case, we realize that both national income and GPL increase. Ceteris paribus. Both national income and GPL are increasing in our economy. So the reverse is true. If interest rates are increased, it means our starting point is 81 and the new equilibrium point, the original equilibrium point, our E0, it will be where we had E1. Our E0 is our E0 will be there, and our E1 will be there. And the aggregate demand function will be shifting downwards when you increase interest rates. It sort of dampens aggregate demand, which is what the central bank in Russia is trying to do, to prevent a situation where there is excess aggregate demand caused by people withdrawing most of their cash in the domestic economy. All other things being equal. All other things being equal. So we see that with 80 shifting from 81 to 80, the level of national income declines. It declines from Y1 to Y0. So things are now moving in an opposite direction. And your general price level is declining from P1 to PZ, from P1 to PZ. So both national income and GPL decline when interest rates are increased. So the increase in interest rates from around 9% to around 20% in Russia is meant to reduce nominal national income, which is inflationary anyway, and also dampen aggregate demand, which will lead to a dramatic decline in the level of prices in an economy or in inflationary pressures in an economy, ceteris paribus. So in the installment that I'm going to send tomorrow, the lecture video that I'm going to send tomorrow, I will explain these things, these issues in greater detail to do with monetary policy. So I hope you benefited from this short demonstration that I just made about the impact of a monetary policy instrument like interest rates when it is increased and or decreased. So this far no further. Thank you so much for listening in. Remember to disseminate these notes to your colleagues. Thank you so much.